How's it going, everybody? Today I'm here with my friend Chris, who is actually running 43 tax firms. He's an Amazon seller in the past as well. So I'm super excited to get into the nitty gritty of doing your taxes as an Amazon seller, the kind of unsexy topic that no one really wants to talk about here. We're going to get into a ton of questions that you guys have been asking me about taxes, a lot of questions he gets as well. But if you just want to quickly introduce yourself, Chris, let us know your background, maybe how long you sold on Amazon, that kind of thing, so that the people know that you're actually a trustworthy guy, and then we can dig into it.
Yeah, I'm glad to be back. I think this is actually my third time on your channel, which is very thankful I'm able to do that. So discussing a little bit about myself, I actually was a seller starting back all the way back to 2005. So I'm a dinosaur. I started selling on eBay in 2005. I went full time selling on Amazon in 2008. I grew that business to about 3.5 million in sales, and then went almost bankrupt in 2013. I restarted back up in 2014 and then grew that Amazon business up to about 13 million in sales. I exited that business in 2020. And during all that time span, I did pretty much every business model imaginable within Amazon. So I did arbitrage, I did wholesale, did private label, also did some drop shipping as well. And once 2020 occurred, we exited a lot of those businesses. And then I went and purchased all these tax offices that you alluded to. So we do have a bunch of retail tax offices. And then in 2022, we started a separate firm, which is Tall Oak Advisors, that's specifically designed for taxes and bookkeeping for e-commerce clients, utilizing that background along with the taxes.
Absolutely. That's awesome. I started e-commerce in 2018, and sometimes I feel like a dinosaur. So you got like like triple the e-commerce experience on me there. So that's awesome. We'll be talking a little bit more about Tall Oak and the solutions that they offer if you guys are curious about all that. But let's just get into the nitty gritty, right? So the baseline question I want to get us started with is for that Amazon seller that's just getting started, should they get the LLC? Should they get the S corporation? That's what I always hear talked about, like first tax question. What's that kind of basic tax setup that a new business owner should think about?
Yeah, great question. I would say that when you're a new business owner, you should definitely stay away from doing an S corp just starting out. You certainly should start out either as a sole proprietor, which you do automatically. If you do literally nothing, you are a sole proprietor. Then the question lies is, do you move over to an LLC? Realistically, that isn't a tax question because whether you're a sole proprietor or an LLC, it makes zero difference for tax purposes. It's actually more of a legal question, and I'm not an attorney by any stretch of imagination. And so what it boils down to is whether you want to have that legal liability section off for an LLC, which is why I would typically recommend most people do have LLCs to have that specific legal side of things covered. But for a tax perspective, it makes no difference. Now, the reason why I said that you should stay away from an S corp is because when you move over to an S corp, you start paying yourself a salary, and realistically, when you're first starting out, it's nearly impossible to pay yourself a salary. And not to mention, there's some overhead with being an S corp. So let's move a little bit forward here and talk about when should you be an S corp. Typically, we recommend sellers to do this once you've hit about $50,000 in profit per year. And what that does is it does save you on taxes. There's something called a self-employment tax, which is 15.3%, which effectively replaces that Social Security Medicare that you have when you're a W-2 employee. And it replaces that. And what an S corp does is it allows you to take a portion of your income and make it not subject to that 15% tax. So it saves you a ton of taxes by doing that, but there is overhead, like I mentioned. You now have to pay a payroll service to handle that. You also have to do a separate tax return. So by the time you factor in all these additional costs to make this work, then $50,000 is usually about the limit we recommend it. So just starting out, I wouldn't recommend it, but then talk to your accountant and move over when it makes sense.
Perfect. Yeah. Good breakdown there. I just see a lot of new Amazon sellers that get confused about, and I see a lot of like business owners in general, like that's like 5 or 10% of the year we're spending just like figuring out how to do our taxes and like the right legal structures and all that kind of stuff. We'll get a lot more technical here today, but it's a good start. As far as like getting all that legal structure set up and all that kind of stuff, I know for me, I was just able to do it simply through my Secretary of State's office. Is there anything that you see people messing up when they go and create that LLC or whatever it is? Should they use one of the paid services, or have you just seen any mistakes that people make in that early process?
Realistically, as long as it's been approved by the state, usually you're in pretty good shape. I personally have not seen very many issues with people doing it, other than the fact that maybe they just didn't put in the proper ownership of it. Because generally, when let's say, for example, you're a partner with someone else, both partners should be on the LLC when you first start, and it should be a partnership. And that's the area where I really see that. But again, it's more of a legal question. And realistically, I don't really see any issues on that end, because from a tax perspective, usually we're just seeing whether they are an LLC or whether they are an S corp. That's not something we necessarily have a whole lot of insight on, but just from experience from being in the industry for 20 something years and knowing how other sellers do, realistically, you can do it yourself. Like I've probably created about 25 LLCs over these years, and it's very simple.
You collect them like infinity stones as you progress as an entrepreneur, right? Ooh, that's a good idea. Let me make a little entity for that, right?
At one point when I was a seller, I had 15 Amazon accounts at one point. So you had to have an LLC for every
Right.
single Amazon account. So that was 15 right there.
That's crazy. Yeah, there's not really much reason to have 15 seller accounts anymore, but I guess you're probably cooking some stuff back in the day with the old Amazon store. That's awesome. We got all the kind of the basic stuff out of the way. From a bookkeeping perspective, like actually going through the year, what should a seller start keeping track of? There's a lot of sellers that kind of started this year. What's the important information that they should track month to month? And what's somebody like you going to want to see when they got to do their taxes?
Yeah, I think really the key here is that you have tracked all your stuff, effectively all your expenses. What we typically see with a lot of sellers is they will start in a couple different camps. One of them, they track nothing. They track absolutely nothing. And if you're in a situation like that, then at the end of the year, you're likely going to have to go to your bank statements and go to your credit card statements, export all your stuff, and then categorize stuff. Realistically, that's an area that this is going to take some time to do. So I would recommend this throughout the year. If you're not actually using bookkeeping software like Books or Zero, then track it in Excel, or you can even track it in something like Inventory Lab, Sellerboard, Boxum, those sort of tools. But the key thing is that all of those tools are not accounting tools. So even if you do use those tools, you still need to have something separate that tracks how you're categorizing your expenses. So that's realistically the biggest thing, is just have some sort of tracking mechanism to know where you spent your money. And worst case scenario, if you have not done it throughout the year, just make sure you have access to all your bank account statements and your credit card statements. Which if you use the same bank the whole year, it shouldn't be very difficult to pull those down. It's when you start switching banks in the middle of the year where you don't have access to your old bank, where that potentially.
Yeah, for sure. I'll give you guys a good pro tip to add to that as well. Something I like to do is I'll use different credit cards for different things. So one of my credit cards is all my software, the boxes I buy, all that kind of stuff. And then another credit card's all my inventory. So I'm not confusing, oh, was this Walmart charge boxes or tape, or was this inventory? Like that just made it simpler for me. That was something I learned.
The other side benefit of doing that is it also gives you an idea of what your spending is in each category without even having to look at your books. So if you're giving yourself a soft limit as far as how much inventory you want to buy, then if you're putting it on a separate credit card, you can say, well, once I hit my limit card, I'm not
Right.
spending it anymore. Or if you're throwing supplies on a different credit card, it throws it off as well. We love clients to do that.
For sure. Yeah. If you guys end up working with Chris, then there you go. There's a pro tip to be Chris's friend right away. Another question that definitely confused me a little bit my first year making money online, when it comes to paying taxes and stuff, who is supposed to pay quarterly? Who's supposed to pay yearly? How does that all work?
Yeah, so there's a few different taxes that you have to worry about. And as the seller, a lot of people are very confused about these topics because you have income tax, then you have sales tax. They're two totally different things, and people just think taxes are all one thing. So let's address both of them really quickly. On the sales tax side, that one is one that if you're just a seller on Amazon or eBay or marketplaces similar to those two places, another one would be Walmart, another one could be Mercari, those type of places. All of those places actually collect and remit sales taxes from customers on your behalf. So if you're just selling those marketplaces, sales tax is not really an issue for you unless you've opened up a sales tax account. If you've opened up a sales tax account, which a lot of people do to try and get tax exempt with the suppliers are buying from, if you're doing that, then the specific state will tell you when you have to file. And generally what you're doing is you're just filing a return that says, I owe you nothing. So that one's dependent on what the state specifically says. Every state's different. So I'd recommend if you do open up that account, just follow what the state says, and that will tell you what basis you need to do it on. But again, generally you owe nothing if you're selling on those marketplaces. So that's the sales tax side of things. Then we go into the income tax side of things. Now, this one's a little more nuanced because theoretically, if you're going to owe more than $1,000 at the end of the year, then you should have been paying quarterly tax. And what the quarterly taxes are is effectively just an estimation of what you will owe at the end of the year. And so let's say, for example, you were supposedly going to owe, let's say $5,000 at the end of the year. Then the expectation is that that should be split into 4 separate payments, and you pay those 4 payments throughout the year. Most sellers typically do, especially in their first year, is they just don't do any estimated payments because they really have no clue what they're going to pay in taxes. So what usually happens is they'll do that first year, and then when you do your taxes in April, you'll figure out how much was actually owed. And if you end up owing over $1,000, you probably will end up paying a penalty during that first year. But then your accountant can give you estimations of what you should pay the next year to avoid what that penalty is. There's actually also some sellers that choose not even to worry about estimated payments whatsoever, and they just pay the penalty every year. And the reason why they do that is because penalty is usually about, right now it's about 8% per year APR, effectively. It's what the penalty is. So a lot of people think of it as a cheap loan. Not that I'm saying
Yeah, it makes sense. I'm hearing 8% APR is a hard loan to get these days. Yeah.
exactly, especially when it was in olden days where it was like less than 4%, there was a lot of sellers that would just say, screw it, I'm just not even going to bother making the estimated payments because it's cheaper for me to keep the money and re-put it into product, especially during Q4, because you can make more money off that money in Q4 than if you send it to the IRS. Now, I'm not saying don't send estimated payments. I personally had to send a ton of estimated payments this year because I didn't want to get hit with a huge penalty, but that's what some sellers choose to do in those situations.
Gotcha. Yeah, I hadn't even considered that. That does make total sense though. Yeah. If you've got a bunch of inventory you want to buy, it's that's not a bad way to get a loan, but just got to be careful you don't end up with a bigger bill than you expect at the end of the year. Cause that kind of brings me to the next natural question I want to ask on that is what's a smart percentage of profit to be setting aside for taxes as you go, especially like you're talking about if you're not doing that quarterly taxes, and at least in the first year, like what percent of the profit you have coming in is smart to set aside?
It's a good question, and it's nuanced, unfortunately, just like everything else is in taxes. Everything in taxes is nuanced, and this one's pretty nuanced, and a lot of it depends on how you're tracking your inventory. Because there's two different ways to track your inventory. There's cash and accrual method. I can go into a whole other discussion about those. But the reality is that if you go the cash method, that means that you're writing your inventory off the moment that you buy it. If you go the accrual method, that means you're writing it off when you sell it. There's a big difference here because if you go cash method, almost every seller, especially the first year for sure, is always going to be negative because you're typically going to end the year with inventory on hand. And you started a year with $0 in inventory on hand. So that pretty much tells you that you're going to be negative profit pretty much no matter what you do. So a lot of accountants will say, oh yeah, just do cash method, but it does have long-term ramifications by doing that. A whole other issue on its own. So if that's the case, then you need to hold nothing back. Now, if you're going accrual method or even in business for a few years, then realistically, you should probably start setting aside somewhere between 20 and 30% is a probably pretty decent rule, 23% of profitability. And again, your profitability needs to be tracked in some sort of fashion, whether that's through Zero or some of those accounting tools we talked about earlier that aren't really accounting tools like Sellerboard, Boxum, Inventory Lab.
Right. Yeah, yeah. Those are good to get a little bird's eye view. But at the end of it, I always compare it to like the actual Amazon Seller Central reports, make sure everything's, perfectly actually what the numbers say they are and all that good stuff. And we're going to get into a lot more of like nitty gritty Amazon specific tax questions. But I really quick want to mention and chat with, as this video is coming out, I know you said you have a sale on incoming tax clients for 2025. Can you tell me a little bit about that and who you're looking for to work with there?
Yeah, certainly. So we do have our doors open right now for anyone that needs some help with taxes, and that we can help out anyone with business, personal. You can do S corps, C corps, sole proprietors, LLCs. You pretty much name it, and we can help you with your taxes this tax season. The deal we're running right now is that you receive $250 off of your tax returns if you sign up before January 9th. And so there's actually a page we've even created for Field of Profit listeners, which is talookadvisors.com/fields. And right on that page, there's a link to get that discount. Not to mention, there's also some freebies we put on there as well. One of them is to discover your bookkeeping options. We put on there seven profit crushing mistakes that a lot of sellers have. There's lots of good freebies on there we've given to your audience as well, but that's the only discount we run the entire year. Pretty much once January 9th ends, it's $250 more expensive.
For sure. Yeah. Yeah. So go ahead and check that out if you guys are looking for a good tax solution. Lots of great Amazon sellers working with Chris and very happy working with Chris. And he also didn't mention it, but there's a free like tax worksheet on there as well on that website. So we'll leave that link down below if you guys want to check all that out. And yeah, definitely get into that if taxes are feeling overwhelming to you, because I know they definitely become a big headache as you scale. Smart to just let a pro handle a lot of that stuff for you. That brings me to another good question I want to talk about though. When someone is coming to you or any accountant that they're working with on Amazon, what specific documents should they have if they're watching this video right now? Like, all right, am I ready for tax season? What are those documents they need?
Yeah. So one of the cool things on our website is we do have a checklist of things that you should have prepared for your tax accountant. So I'll go through a kind of a list of what these things are. Number one is you should have your settlement statements from any selling platforms you've sold on. So that would be if you sold on Amazon, if you sold on Mercari or some of these other places. Each one of these places have settlement reports that you can download that show what your income was and shows all the expenses you had on those platforms as well. And so that's number one, is you'll need all of those. Number two, if you received a 1099 from the platform itself, then you would need those as well. A 1099K is just something that the platform gives you if you sold over $5,000 in sales. And this also sent to the IRS. So that way the IRS knows how much stuff you sold. Now, I did mention there that it's over $5,000 this year. That's changed from prior years. In prior years, it was $20,000, and there was talk of them changing it to like $500 or $600 at one point. And so this year they did make the change. It's $5,000 this year is when they'll issue it. Keep in mind, if you are under $5,000, even though they don't issue a 1099, you're still required to report those sales to the IRS, which is why those settlement statements are extremely important. So we talked about the settlement statements. We talked about the 1099Ks. Then then you also need to have your documentation as far as your actual expenses so we know how to drive down those income numbers. What you would need on that is documentation of what your cost of goods sold is, which usually you can pull that from Inventory Lab, Seller Board, Box, and you can usually pull those from those areas. And you also need documentation of what your expenses are. So the expenses, you would typically pull those from your credit card statements, bank statements, or obviously if you have standard bookkeeping, that would also have it in those places as well. Now, keep in mind, if you're just using a tool like Seller Board, Inventory Lab, Box, some of any of those tools, then the challenge with those is that even if you do enter any expenses on there, they're not necessarily tied to the bank accounts and credit card accounts. So you need to have some sort of tie in between those, which is why when clients come to us and say, oh yeah, we got everything in those tools, it's a problem because it would not pass an IRS audit whatsoever. So you need to have something having a document trail, which is the reason why when you mentioned earlier, we have that business tax worksheet. The business tax worksheet is designed to have you pull all the data from your credit card statements and bank statements, put into a spreadsheet so that way you have a documented trail of how you came up with the expense numbers or put in your tax return. So those are like the basic things you generally need to have on the tax return in preparation for the tax return. And yeah, I think that's basically about it.
Sweet. Yeah. Sounds like a lot, but it's really not too much. If you guys are looking for like the 1099, Amazon usually gives it to you like the end of January, along with everything else. You just download it. And then the complicated part is making sure you did a good job of tracking all the transactions you ran that year. If you did do a good job, it might be a couple day project of marking down which thing was what. I know I definitely put it off too long in the early days.
No, I
That's
I have a quick
thing.
story about that.
Yeah. Yeah.
Back in the day, like I've not been the perfect bookkeeper in all my years. Obviously, over time, I've gotten a lot better. And now that I own a bookkeeping and tax business, obviously, I fully know the intricacies. But back in the day, I was doing just like everyone else. And there was many years where I literally would do zero bookkeeping the entire year. And then my accountant would be like, oh, yeah, we need this stuff in by whatever day it is. And I would literally be like, to file the extension. So they file the extension, which everyone does. And so we file the extension, which then allows you to wait till October to get done. So I would see myself like late September, like literally going through all these old bank statements, trying to figure out what the heck I did a year and a half ago. And it's an absolute nightmare. And it was so stupid that I was doing that back in those days. And like literally, it would take me like 2 or 3 days, just like counting through all this stuff. And
Pulling like a college all-nighter just to
literally,
categorize some transactions. Yeah.
I literally did that for probably 3 or 4 years in a row. And I'm like, this is just stupid. This is absolutely stupid. So I finally hired an actual bookkeeper to actually take care of my books and went a lot smoother after that. But
Of course. Yeah.
even someone who's been around in business for 20 something years has stories about days where they did that stupid stuff.
Right. Yeah. That's funny. No one wants to deal with it. So that can be what happens as an entrepreneur. Sweet. So I have another topic I want to hit with you in terms of leakage. A lot of us are buying inventory and maybe the supplier shorts us a little bit or Amazon loses it, that kind of thing. How does it work when it comes to writing off inventory that maybe you have sitting around or you like went lost through the process? Like how should you treat that on the books?
Yeah. So again, it boils back to what is your method of tracking for your inventory. If you're doing cash basis, it doesn't matter. It's already been written off. It makes no difference because again, the moment that you buy it, it's written off immediately. Now, if you're using a accrual method, then you do have to track in some fashion. So you're trying to determine, all right, if I have stuff I've thrown away, you need to have some sort of documentation showing that you've done this. So if you've thrown it away, do you have pictures of you literally throwing it away? Do you have a log of everything you are throwing away and then pictures showing you doing it in case you ever got audited? Because otherwise, how really do you prove you threw something away? It's hard to say, oh yeah, that inventory is
The garbage can gives you an invoice or something. It prints it out when you throw it in the garbage can. Yeah.
Exactly. Realistically, if you're selling like in a grocery category and you have expired goods, like what else can you do with it? Not really do anything with it. Or if like you get some returns where, let's say a Halloween costume where some kid decided to just scrape it on the in the dirt and there's like dirt all over. There's no way you're gonna resell this thing or anyone wants to take it. Those are the type of things that like you're probably gonna have to end up throwing away and no one's gonna want to buy them. And you just need to have some sort of proof of a manifest showing what you did and a documentation showing how you did it. Another option is to just bundle it up into just something you sell to someone. And at that point, it just gets lumped into your cost of goods sold. So let's say you have like 50 items that's just all been these crap returns, which happens to everyone. Then you can just throw it on eBay for $10 or so on Facebook Marketplace for $10. Whole box, take it all. Make sure you have a documentation and picture of what you're selling. And that way, when you get ready to write it off, if you ever have any documentation that you need, you easily have a proof of all that.
That makes sense. And I also remember seeing some of the stuff you were writing in terms of donation, maybe not being the best way to take some of the write-off for that old inventory. Can you talk a little bit about that as well?
Yeah, the challenge, donating things is good. It's a good thing to donate, but if you're going to donate, don't think you're going to get these massive tax write-offs unless you have so much stuff to write off. It's a different story. There are certain nuanced categories where you can write off donations, but unless you're in one of those nuanced areas, it doesn't make any sense for most people. The reason being is when you donate something from an LLC or a sole proprietor or an S Corp, which is majority of people listening to this, what's happening is that you're actually donating that personally. You are not donating that as a company. And so when you're doing that, now that donation becomes just a standard deduction against your personal return. Problem is that charitable donations are also lumped in with any sort of itemized returns you have on your tax return. So something, this is like going into very big detail here, but if you go back to 2017, before that, you used to do something called itemized deductions where you would write off your taxes and you'd write off your mortgage insurance and all this other stuff. And then 2017 came and there was a new law that came through that bumped up the standard deduction. And now the standard deduction is so big, I believe it's like $21,000 this year. It's so big that you pretty much need enough deductions that's larger than that to be able to even count for any additional. So for example, if the standard deduction is 21 grand, then you need to have $21,000 of deductions before you can even take on another dollar. And so if you only have $5,000 of donation, you would need another $21,000 of deductions before you can even see that $5,000 being made. Usually your best option, if you're looking for tax savings, is just to sell to someone for $5 or $10 on
Right.
Facebook
Yeah.
Marketplace, or document that you had to junk it out or throw it away, or send it to a liquidation company. Find someone to take it for
Yeah.
some ridiculously low number, which is justifiable because it's damaged goods and that sort of thing. Only donate if you legitimately just want to donate because of your own goodwill and you want to have a big smile on your face. But if you
Right.
want
Yeah.
that's not going to put a smile on your face.
I say you write something about that, so I wanted to put that here in the video as well because I thought that was interesting. Like I always thought, oh, you donate, that's a tax write off, right? That's how it was when I was growing up. So it's definitely changed. So just keep that in mind. So maybe if you guys see a whole bunch of old shoes and vitamins and all kinds of stuff for $1 on Facebook Marketplace, you probably know what's going on there. Maybe a good place to source some eBay inventory or something like that.
Maybe.
Yeah, sweet. So another topic I was seeing some people ask about as well is how should they treat their taxes, income tax, all that kind of stuff if they're wanting to move out of the country, for example, like popular with a lot of make money online people is like going to Dubai. Like how does that look? Is it the actual like tax cheat code people like to treat it as?
Not really. Once you move out of the country, there are exclusions in the US where you don't get taxed on a certain amount, assuming that you are full time out of the country. But the reality is that you have to literally live in the other country and be a citizen of that country before you can take that specific exemption. The reality is that anything you make in the US, even if you move somewhere else, is taxed in the US. So it's really not that way. The things that you're talking about here, if you're really trying to like escape the tax burden of the US, typically what you have to do in those scenarios is create some sort of other entity in those other countries and then have that country charge your US based company money. So that way the US based company shows zero profit, but then your Bali company has $500,000 of profit. That's how the large conglomerates shift stuff around. Because they're just charging fees back and forth to various companies, but there has to be like some sort of like legitimate reason why you're doing that. So if you're actually like in Bali and you live there and now you're hiring Bali employees, then it makes sense that you would want to have a separate Bali company for that. And you can charge a company and all that good stuff. But yeah, it's not as easy as you would think. I'll just move out of the country and boom,
Right.
they're gone. The one exception to that is if you move to Puerto Rico, which is technically, yes, it is technically a different country, but it's actually US territory. And they have an agreement where you can only have to pay 4% in federal taxes. And there's no state tax, but there's nuances with that as well.
Yeah, I remember looking into that one a little bit. It's a little bit far away from family and all that kind of stuff, but that one's interesting.
I know a lot of Amazon sellers
Yeah.
that have moved to Puerto Rico. And there's actually expat communities in Puerto Rico where there's a bunch of these Amazon sellers and they live in a very nice area of Puerto Rico and they're living large off their 4% tax rates.
Right, yeah. So for those of you guys that are on the I'll just move to Dubai train, maybe that's your actual thing to consider there. A completely 12-hour different time zone as well. Lots of different problems with that plan there.
And they have Costco's there.
Hey, there you go. That's all you need, right? 4% income tax and Costco. I'm there. I'm there. Sweet. We were talking a little bit about leakage, and I also wanted to ask you about this. Is there any good systems that you've seen people implement in order to track like the inventory that's actually going missing through their business? I meant to ask that earlier, but just curious on like things you've seen from your clients.
There is no foolproof system. Realistically, if there was some sort of software tool out there that could actually track all of this stuff, which honestly there is, there are software tools out there that theoretically could do this, but they're inventory management pieces of software that realistically you need to probably make $20 to $40 million in sales to be able to justify the cost of these sort of systems. And so usually what we see for a lot of smaller sellers is if they're going to track it, which most do not, because the overhead for trying to track that versus the amount of money you actually lose, you're typically spending more labor just tracking the stuff than you are with that you're actually losing. So it ends up being a wash at best in most cases. Not to mention like where you can get the money back anyways. Are you can get it from Amazon? Or you can get it from your prep center? Like where you can get it from. So it's one of those cases where realistically most people don't track it. Pretty much what they're doing is they're saying, all right, what's my inventory at the beginning of the year? How much should I actually buy? What's my inventory at the end of the year? How much should I actually sell? Do all the math. And when there's a difference of stuff that's left over, that's what's missing. That's what's been stolen. We write that off. And that's what a lot of people typically will do. Now, the real challenge as a seller is, all right, well, I just lost $15,000. What the hell happened to it?
Yeah.
And so that's really where you have to start thinking about, okay, where did $15,000 disappear to? And that's where you potentially can get a VA involved and start trying to track some of the trails and figure out, okay, I saw that there's this chunk of money of $5,000 disappeared. Like, where did it go? And then start following the trail of like where some of the product went. Look back to see, I bought it here, it's shipped here, where did it go? You can do those sort of trails as long as you're tracking your inventory properly. But again, that's usually a retroactive thing most sellers will do on the backside just to see if there's something specific that they're doing that is causing these errors. Like, it's possible you could be using a prep center that's just shady as hell,
Right.
and they're stealing half your inventory. Like, you could find that out by doing that sort of audit or even auditing the prep center. So that would be a situation where it may make sense. But in most cases, it's like Amazon taking your inventory. And if you're using services like at IDA, Refund Manager, those sort of places to grab a lot of that back, realistically, you're probably getting most of the money back that you probably would be losing anyways. So there's no great system other than just trying to backtrack the losses.
Yeah. For those of you guys, if you've never looked into like how much inventory might be going missing from suppliers and that kind of stuff, I really encourage you to do that. I didn't think it was significant until I really started looking into it. And then I hired somebody that specifically half our job basically is tracking that kind of stuff down now. So especially if you guys have been able to scale this thing pretty significantly, it's probably a good chunk of change. I would really start digging in, set a certain number of weeks where, hey, if we don't see this moving through the prep center and we bought it, let's talk to the supplier, that kind of stuff. And you'll track down a lot of missing profit there, because there's a big difference between a negative 100% ROI and being able to even sell something at break even. The products don't go well, but when products never show up at all, that's a lot more expensive than taking a little bit of a loss on something.
Yeah, we have some larger sellers that literally have a full-time VA do nothing but track product. That's all they do. And so, like, to answer your question, yeah, there is a way to do it and there are ways to do it. But again, you need to be a pretty big operation for it to really logically make sense to pay someone a full-time salary to dig into stuff, which if you're large enough, it makes sense. But when you're starting out probably less than $1 million in sales, the likelihood of you actually gaining enough to offset the cost of somebody digging into it probably isn't there.
Yeah, because if you're paying a virtual assistant, you're gonna anywhere from $500 to $800 a month is probably what you guys are looking at for somebody to track all that down. So if you think that cost savings makes sense, then something we probably want you to look into there. Another question I wanted to chat with you about. I know we said it's a whole can of worms here on like cash versus accrual, that kind of thing. Is the main downside of the cash system that last year you're in business is you're going to get a massive tax bill? Because it sounds, when people are probably hearing this, cash sounds a lot easier. Everybody's accountant saying to just take the easy road there, because there's got to be something at the end of the road, I would assume.
Yeah, so that's obviously the biggest one. And the reality is, which I like the real talk on when I talk to people, is most businesses don't stay in business longer than 2 to 3 years. That's just the reality of it. Now, either they're going out of business because they are just not good at their business, weren't profitable, or maybe they sold it. Either way, the likelihood is that you exit your business at some point. And so what happens is that when you do that, when you're using cash basis, all you're doing is just pushing the ball down the road. And the challenge with that is that the way the tax brackets are, when you have income at lower income levels, it's taxed less than when you have more income in the same year. So the challenge is that when you keep kicking a can down the road, then what happens is that if you have no other income coming in, then you're effectively taking income that could have been taxed at a lower interest rate, pushing into a future year. And then if that 1 year where you end up going out of business or you end up like selling it and you end up having a ton of income off of it, you may have now paying 37% tax rates on something that you could have paid 10% tax rates 2 years earlier.
Right.
That's obviously issue number one. Issue number two is it makes you look unprofitable for everyone who potentially would need to know, are you profitable? Let's say you're trying to buy a house. Good luck getting approved if it's saying you made no money. You're trying to get approved for any loans for your business. Try to get approved for a loan with your business when you're unprofitable because your taxes show you're unprofitable. Good luck. That's another challenge here as well. So if you're looking for like really high growth, most sellers will usually take on debt at some. Obviously, the easy money is out there with Amazon where they don't ask for this stuff. But if you're a true real business, you're typically going to either grow from investors in the future or you are going to grow from bank loans. And both of those are going to need financials that show profitability. Otherwise, you're not going to loan to your order to invest in your business. And so that's the other challenge, is that when you do that, when you go into cash method, is it effectively eliminates all the back end work that you can do. I've had that problem in the past. Like I remember at this point, probably about 10 years ago, maybe about 9 years ago, somewhere around there. It would have been before I went almost bankrupt. It was a year before that, but probably about 11 years ago. I was in the process of buying a house and I was using cash basis at the time, which made me look unprofitable. I remember trying to buy a house and it was nearly impossible. They were literally asking for W-2s and I'm like, I don't have a W-2.
Yeah, it's hard enough to get approved for things as an entrepreneur to begin with, let alone if you're showing you're not profitable on the books.
Yep. And then they looked at the tax return and they're like, that's not going to work either. And so like we ended up not getting approved for a loan because of the fact that we just had tax return to show we made any money, which is great because now I can government cheese because I make no money. It doesn't work for other stuff. There are some benefits that you really have to think about your specific situation. Does it make sense for you? Because what makes sense for you might be totally different than the person down the road.
Yeah, that's a very helpful breakdown because a lot of the stuff we were talking about, even I was like, wait, why am I not on cash? And I was like, oh yeah, there's some good reasons. There's some good reasons. Because at first I can definitely see there's a scenario where you keep kicking it down the road and then the last year you go out of business and also you have the biggest tax bill you've ever had. There's probably a reason you went out of business and now suddenly you owe a bunch of money and you're in a bad spot in that case for sure. Yeah. So another good question for guys and gals who are getting so they're starting to make money. People ask me all the time, like, how much should I pay myself? Like, how do I even pay myself? So for that seller, they're starting to make money. They've probably got the LLC. Somebody who's watching this, they got an S corp. They know what they're doing. If they've got that LLC, they're starting to make some money. Like, how does the logistics of paying themselves? How does that work? And then where do you recommend people start paying themselves a little bit of money?
Yeah, so actually physically paying yourself is incredibly easy. You just do a transfer between banks.
Yeah.
You can also do like a Venmo payment. You can do Zelle payment if you want to. You can do any of that stuff. Just moving money out is easy. Like that's a simple part of it. Now, when you should take it out is a totally different question because that was, again, very nuanced on your specific business and what your growth patterns are. So what we typically recommend for most sellers is to not even think about taking money out of your business for the first year, which I know sounds incredibly harsh and it makes it very difficult for someone to try and go out of a 9 to 5 job and then try to shift into Amazon full time. It can be done. I'm not saying it can't be done, but the reason why I typically recommend that year's worth is because most people that start these businesses don't start with a lot of capital to begin with. They don't have a ton of money. And so what happens is that when you're trying to grow, it is very cash intensive. You have to put as much cash into the business as you possibly can in order to make it as healthy as possible and to have it grow as quickly as you possibly can. Now, some people decide to just get 15 credit cards and get 15 loans and all that good stuff, which that could also fuel your growth as well. But the more you do that, the riskier business is. And realistically, every business is risky. There's risks in a lot of different things. But the reality is that especially if you're doing arbitrage or doing things where you're reselling things, there's Section 3 violations. There's also, I'm not trying to dissuade anyone going into business because it's a very lucrative business, but there are risks involved already inherently with selling on Amazon to begin with. And then when you put in the fact that you just light a fire with debt, you're basically just taking a already semi-risky position and just taking the risk level to like a rocket level.
Even if you're not breaking the rules and you got to get back. And I've even had in the past where it's like, we was 3 or 4 weeks, our account was shut down. I had to submit a bunch of documents. We weren't doing anything wrong. We got the account back. But I can imagine if I was using 15 different credit cards and over leveraged, then that's a lot more stressful situation than just, oh man, I'm down some income for a few weeks here.
I still remember the first time I got suspended. Like I was suspended. This was probably 2016, I think somewhere around there. And we did nothing wrong. We did literally nothing wrong. We got suspended. And at this point I had a bunch of employees. I had a warehouse. So now I have to do all my employees. Like I had to keep my employees and I had a bunch of money on debt, obviously. But at this point, because of my failures in the past, which was taking a lot of debt, I was very risky when I was younger. I was a lot smarter the second time around where I had cash reserves. So when I did have that suspension, which took 3 weeks, that suspension took 3 weeks. When it finally came unsuspended, I was very happy, but I also was not getting ready to go out of business because I was able to support all those expenses during that 3-week suspension. So that's one of those cases where even though, suspensions theoretically should never happen, they do. And when they do, you need to be prepared for those things. So that's why you go back to your original question, like when should you take money out? Usually for most people, the first year, you probably shouldn't take any money out. But let's say you're like, I can't do that, Chris. Got to take money out of the business. Otherwise, I don't feel like I'm doing a damn thing here. That makes logical sense too. So you have to start thinking about, all right, how much can I logically take out of the business without really making it suffer? For most people, if you're going to start taking money out, I would say start with somewhere between 15 and 20% of the profitability that you have is probably a good range to start out with. So if you're profiting, let's say $1,000 a month, take out like 15% for yourself, take out another 15, 20% for taxes, and then we'll leave the rest of it in the business for growth. That's what I would recommend in a scenario like that. And you can use something called Profit First, which a lot of people talk about using Profit First for e-commerce. That was actually quoted in that book. Some people don't know.
That's a cool flex. That's actually a cool flex.
Yeah, I was actually quoted. That was even before I even had these tax
That's cool.
bookkeeping businesses. I was quoted in that book. But that's another method that you can take is Profit First. If you're unfamiliar with that, there's a book called Profit First for e-commerce sellers that you can get on Amazon or anywhere else. And effectively, it's just a budgeting system. It says you want to take your profits out first, and then you have your buckets for various things. You have buckets for inventory, bucket for your operating expenses. Basically, you're just, if you've ever used the old envelope system, you ever heard of this envelope system back in the day? You ever heard about that?
Yeah. Yep. I was on the envelope system when we were growing up. I remember parents were getting out of debt. So it was like everything's in cash. Yeah. We were on that.
Yeah. If you're unfamiliar with this, basically you would get like $100, then you would have 5 envelopes and say, this is for groceries. This is for going out to the store. And so you have $3 to go to the store, whatever it is. But you physically take the cash and put it in the envelopes. And then when the money in the envelope is gone, you have no more money to spend. And that's the philosophy of what they're doing with
Mhm.
Profit First. You're just putting stuff into various envelopes, if you will. That way you don't overspend in various areas.
Yeah, and for me, I didn't take money out for well over a year. A lot of other successful sellers will tell you the same. And if you're starting this and it's something that you like, this is my escape plan. I hear it a lot. Like, I'm going to quit my job next month. Like, Amazon's probably not the one for you. You probably want somewhere you're spending a lot of time to make money. Because I know a lot of great Amazon sellers who keep their 9 to 5 jobs. Because Amazon, if at scale, once you really got it done, like it'll take you a couple hours a day. So if you're really hustling hard, you can keep the 9 to 5 job, keep your benefits, do 50 to 100 a month in revenue. There's several people that I know personally that are doing that. There's no reason to like have this weird view of, oh, I got to quit my job ASAP. So it's just like keep that realistic view about it is I think what we're both hitting on there. So
Yeah, we have a lot of clients right in the same bucket. We have a
yeah,
lot of
yeah.
clients doing the exact same thing. They're just part time and they're killing it. They're absolutely killing it, making a lot of extra money, plowing it back to the business. Like I've looked at financial reports where literally they have not taken a dime out of the business and they made like $300,000. Obviously, once you have to pay taxes, you got to take money out at that point, but they literally haven't taken a dollar out. And it's, man, how do you make 300 grand, not take a dollar out? But they also have a very big strategy where they want to be long term, where they're just plowing money back into the business and then having that big exit at the end where they can then take all that money, put into real estate or something else.
Yeah, exactly. Yeah, give yourself a good payday, good retirement when you're all done with it at that point. If you're a couple years, that's buy a couple houses, some easy income there. Yeah, that's it. That's a good game plan.
A great
So
strategy, right?
yeah.
You got like apartment complexes, right?
Hey, maybe later down the line, that is part of the plan. You can only do so many things at once, though, right? I also see a couple questions I know you've been hit with before, but specifically to Amazon, as far as margin boosting things. Like number one is discounted gift cards, right? So how would you recommend people do their accounting for discounted gift cards?
All right. So the discounted gift cards, if you're, let's say you're using, which this is a majority of the people probably listening to this, are probably using some sort of a profit tool, which for this example, we're talking about tools like Sellerboard, Boxem, or Profit Cyclops, Inventory Lab, all these other tools they have out there. Typically using one of those. And so what you want to do is you want to track what the buy cost is in each of these tools. And my recommendation typically is to take whatever the discounted rate is and put that in as your cost of goods sold. And that's what I typically would recommend doing if you're using those sort of tools, not really using any sort of other like tool. Now, when we're doing it for bookkeeping purposes for clients that they're purchasing these various things, we tell them to do that, but what we do is we take those gift cards and we put them in inventory at the original amount that they bought it for. So if they bought it for $800 or whatever, we would put in their $800 for the amount that they have as an inventory asset, even though it's actually worth like $1,000. And so as your inventory starts selling through, you end up gaining that difference in the books by knowing what the balances are at the end of the year. It's the whole bookkeeping thing here, but from a specific seller standpoint, my recommendation would be is to track it at what the discounted rate is based on whatever the discount was you got for that specific supplier. And so you do have to do some math because sometimes you're buying a gift card. Let's say you buy a $100 gift card and you spend $120. Then you say, okay, my $100 gift card only cost me $80. So my total for this was actually $80 plus if you bought for $120, then it's 20 plus.
Yes.
So like,
You chose some complicated numbers for yourself there.
yeah, but anyways, you get the idea that you basically just want to figure out whatever that the discounted rate is, and that's what you want to do at a level of tracking gift cards can be a little bit of a challenge, but it certainly can be done. We used to buy a ton of gift cards when we did our arbitrage. I've shown screenshots to some people at times of the amount of money that we've saved off gift cards, and it's staggering the amount we.
Yeah, I'm hammering them all the time about those margin boosters. So you heard it there. People who've even scaled 8 figures on Amazon are hitting the discounted gift cards. So
I was probably buying gift cards off Raise while you were still in elementary school.
that would be 2009 is when I finished elementary school. So you're probably right, actually.
Maybe you're like a sophomore, maybe you're
Okay, cool.
a freshman when I
I'll
was.
take it. I'll take it. Cool. And then the other one I know you get asked about all the time is how do you treat cash back as far as taxes go?
Yeah, so this one has a lot of like gray area based on who you ask and what the accountant seems to believe. Because the reason being is, let's say you do a Google search and you just do a quick Google search and you say, is cashback taxable? The first response is going to come up is going to say, no, it's not taxable. And the reason why it says it's not taxable is because cashback is generally derived from a consumer perspective. So typically when we're talking about from a consumer perspective is, let's say you're buying something off Nike.com for yourself personally, you're buying some socks or something like that. And you spend $100, you get 10% cash back. So you get $10 back. So they consider this to be a rebate. And so what happens is that $100 you spent on those socks, which is pretty expensive socks now that you think about it, it's actually $90. is what it is. But for you personally, it doesn't matter because it's not like you're paying taxes on you buying that $100 pair of socks, which again is way over. So that's the reason why they say it's not taxable, because you don't get taxed on stuff you buy. But now let's think about it from another perspective here, is that when you're buying stuff to resell, let's say the same thing. You have a $100 pair of socks, which again, there's no way you're making money off this with me here. Let's say you buy your $100 pair of socks, you get 10% cash back. Well, again, IRS says they're rebates, which means it lowers the cost of the item. So if you have that 10% cash back, which makes you gives you $10 back, it's a rebate against the item, which now makes your cost of goods sold only $90 instead of $100. Theoretically, you should be logging your cost of goods sold as $90, not $100, because it is a rebate against the item. And so inherently, because it lowers your cost of goods sold, makes you more profitable, which means you should be paying taxes on it. That's those cases where if it's in the business, it absolutely should be taxable. It should be taxable income because it is money that came back. The reality is we see a lot of sellers don't heed that warning at all. They just throw it into their personal checking account and it just poof disappears. And I'm not telling you to do that. Again, I'm not telling you to do that whatsoever, but that's what some sellers do. And you can understand the reason why they would do that, because the IRS doesn't even know you even got the money to begin with, unless they somehow audited you and they started like digging into your bank account to see where you got the money. Like, it's possible, but
You got an Amazon seller auditing you somehow? They're like, "Hey, what about your Rakuten account, man?"
possibly, but the IRS doesn't even know you even got the money in the first place, which is, I think, the reason why that you see that no one really does anything about it. Not to mention, I personally have not seen any specific cases where someone has gotten overturned where they've had to pay the money back either. So when you think about it from a tax perspective, if you're an accountant and you're saying, all right, there's no ramifications for doing this, IRS doesn't even know about it, then why in the world should we report it? Again, everything is taxable. Every income is taxable unless there is a specific exception in the tax code that says it's not. That's how they get people for tax evasion.
Right. That's how they get like Al Capone and all that kind of stuff. Yeah, yeah.
Exactly. That's how they get you, because everything is taxable unless there's an exclusion. There is not. There is not a specific exclusion that says when you buy stuff on a credit card for your business, it is not taxable. There is no law that says that anywhere, unless someone can like somehow go in the comments and say, "Oh yeah, I found this law," and give you an actual link to it. I have never seen one, which tells you if you've never seen a law that specifically says that, everything is open to the interpretation of other things that have happened in the past. And so the reality is that's our stance, is that we recommend that you do claim it. But I can honestly see why other accountants would say you don't have to. I can also see why some sellers be like, who cares? Whatever. There's a lot of kind of like gray area there on how you'd handle it. For us, we really care about our clients. We also care about them getting audited. We also don't want to be the company that has to battle the IRS for the one instance that happens. I'm not sure if you're aware of this case. There's a seller that used to have, his name was Abraham Eisenberg. Does this guy name ring a bell though? He's an old Amazon seller. He sold for a long time, and I know him for many years. And he ended up getting on Amazon and all this good stuff. He went into crypto and he started doing all this crypto stuff. And he ended up doing something that he thought was not illegal, where he effectively took $60 million out of some crypto fund. And he said it was the profitable trading strategy or something like that. There was an exact term he used. He said it was a highly profitable trading strategy, I think was the line that he used. And again, there was no specific law that specifically says, Abraham, you can't do exactly what you said. But guess what? The SEC decided to say, you know what? We're going to use you as a case to show that what you did was illegal. And so they took him to court. He lost, and he's been in jail now for at least 2 years, I believe. 2 or 3 years now he's been in jail. I used to talk to the guy on Facebook. Like I used to talk to him in Messenger every so often, and he would always throw like business ideas my way, and I'd be like, no, you're like shifty in some cases. And but interesting guy. And I met him at conferences and Amazon conferences and stuff, and now he's sitting in jail. And we don't want to be the people that happens to because of cashback. It makes no sense.
Set the tall oak precedent against cashback. Yeah. Yeah, that's funny. Sweet. So I really appreciate you spending this much time here. For that guy or gal, they're trying to get that last minute tax prep, all that kind of stuff taken care of. Can you let us know what you can help people out with and remind us what that deal is you got going on right now?
Yeah, I'll give you a few tips like year-end type things that you can do, because this is going to be released slightly before January 1st. So the key thing that you'll want to do before January 1st is, if you are in cash basis, try and buy as much inventory as you can, because it just wipes out as much income as you have. So take a look at that. If you have things you can prepay, then you should be prepaying for anything right now that you can do into the next year. So if you have a course that you want to buy, or if you have something you want to buy like an annual license of, do it right now before December 31st, because it can become a write-off for this year, even though you're getting the services next year. An example of that would be our tax services. A perfect segue into that is, if you do sign up before December 31st, even though we're going to perform your tax services next year, you get the tax write-off for this year, and you get the $250 discount that we talked about earlier. So I would strongly recommend doing that. We can help you out with that. And then also, if you're like, you know what, I'm not really sure if my bookkeeping is straightened out, we can also help you out with your bookkeeping as well. We have a tax-ready bookkeeping service, which is actually half the price of what our normal bookkeeping is. We released that this year. We didn't actually do that in prior years. It's designed for those sellers that are lower volume, that really didn't do a great great job of tracking their stuff, but they're not really ready for like full scale bookkeeping service. So we could like this hybrid.
Yeah, that makes total sense because I
Keep it,
remember, yeah,
keep
early
it.
days, it's I don't really want to spend $500 a month on bookkeeping or $1,000 a month, but yeah, you can go and have you need a little bit of help basically.
Yep. So we did that this year where we're offering that to our clients. Obviously, it's not needed, but we do have that as an option for some clients as well. So if you sign up for our taxes, you'll have that option as you go through our tax process to have some help on the bookkeeping side as well. If you want to do any of that, feel free to go to talloopadvisors.com/fields. That's where you'll be able to find all those videos I talked about earlier, that business tax worksheet, the 7 profit crushing mistakes ebook that's on there as well, and the $200 discount.
Awesome. Yeah. So go check that if you guys want to lock in that discount, all that good stuff. Also, make sure you follow Chris Potter on Twitter. He's a great follow, always dropping lots of good, helpful stuff. I'm always reading through a lot of the stuff he's posting because it's very helpful, no matter what kind of business you run. Really appreciate you hopping on here today, Chris. Everybody comment down below if you learned something from Chris. Let's show Chris some love if we want to have him back next year. Maybe he'll come back and share some more game with us as well. Really appreciate you spending the time, Chris, and appreciate all you guys watching. If you want to hit subscribe, all that kind of good stuff, helps me out with the YouTube algorithm as well. But appreciate you watching. I will see you next time.
Thanks a lot. See you guys.